Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lumentum.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
And we have to start with the momentum on this one because the numbers are, well, they're almost hard to believe.
They're staggering, yeah.
We're talking about year-to-date gains of somewhere between, 340 and 370% for 2025. The stock is near $395, setting new records constantly. This is not normal.
No, it's a full-on parabolic move. And the answer to why is pretty simple in a way. It's AI.
The AI revolution.
Exactly. Lumentum has really become what you'd call an AI picks and shovels supplier. And the key thing to understand, the real tipping point, is that over 60% of their revenue is now directly from AI infrastructure and cloud services.
So they're not just a general supplier anymore. They're at the very core of the build-out.
They are providing the essential optics for these new super-fast data centers.
And the recent earnings really back that story up, right? Q1 for fiscal 26 came in at $533.8 million.
Which didn't just meet expectations. It blew past last year's number by almost 60%, 58.4%, I think.
That's a huge acceleration.
It is. And the EPS, the earnings per share, did the same. Came in at $1.10, also beating forecasts. But honestly, the past quarter isn't even the biggest part of the story.
It's the forward guidance.
It's the guidance. They're projecting Q2 revenue between $630 and $670 million and non-GAAP EPS between $1.30 and $1.50.
Wow. So they're telling the market this isn't slowing down, it's actually speeding up.
That's the signal. The ramp is intensifying.
Okay, so that top-line growth is obviously incredible. But let's talk profitability. Are they actually making money on this, or is it just growth at any cost?
That's the right question. And yes, they are. This is really the heart of the bull case. They're seeing higher factory utilization, which is spreading out their fixed costs.
Right, economies of scale.
Exactly. And more importantly, they're shifting their product mix toward these really high-value proprietary AI components.
Which have better margins.
Much better. It pushed their non-GAAP gross margin to almost 38% in Q4 of 25. And management has been very clear, they have a target. They want to get that number close to 40%.
And if they hit that, it's a whole different financial picture.
It really is.
Yeah.
With operating margins heading into the mid to high teens.
Okay, but there's a bit of a paradox here I want to unpack. You're saying gross margins are strong, almost 38%, but the trailing EBIT margin is still negative. It's minus 2.8%.
Right.
How does that work? How can they make money on each product but still be losing money overall from operations? Where is it all going?
It's going right back into the business. That negative number is a direct result of just how aggressively they're investing to capture this boom.
So R&D, retooling factories.
All of it. Heavy spending on R&D to stay ahead, plus restructuring costs to get their facilities ready for these new AI components.
Yeah.
They're spending money today to own the market tomorrow.
Got it. So it's a sign of aggressive investment, not weakness. But that kind of spending takes cash. What does their balance sheet look like? Can they sustain this?
It looks pretty solid, actually. Their liquidity ratios are quick ratio is just over 1. Current ratio is about 1.4. They have a really significant cash position.
How much?
As of the last quarter, it was around $877 million. Plus, they just secured a new $400 million credit facility. So they have plenty dry powder to fund this expansion.
Okay, but I also see a red flag here. The debt-to-equity ratio is high. Some reports have it as high as 4.2. That's a lot of leverage.
It is. There's no question that's a risk. A DE of 4.2 means they're leaning heavily on debt. Now, in a mature, slow-growth company, that would be a huge problem.
But here the argument is different.
Right. Here, the market is betting that the debt is being used for high-return investments that the hyperscalers are demanding right now. For the moment, their cash flow seems strong enough to handle it, but it does add an element of execution risk.
Okay, so a balancing act on the financials. Let's talk about the competitive moat. Why is Lumentum winning this business over, say, a Ciena or a Marvell? What's so special?
It all comes down to their proprietary photonics IP. They are leaders in something called external modulated lasers, or EMLs.
EMLs. Okay, what do they do?
Well, think about it this way. Traditional data center parts are hitting a speed and a power wall. EMLs are the component that lets you send data at super high speeds over longer distances within the data center while using way less power.
Ah, so it's not just about speed, it's efficiency. And for these giant cloud companies, power consumption is a massive cost.
A massive cost, exactly. So this is complex, custom hardware. And because it's proprietary, it creates incredibly high switching costs.
So once a hyperscaler, Google and Amazon designs Lumentum's chip in, it's really hard to design it out.
It's expensive, it's time-consuming, it's risky. These are long-term design relationships. They become a mission-critical partner.
And isn't there a new product coming that's supposed to cement that relationship even further?
You're talking about the R64 optical circuit switch. Yeah.
So what's the big deal with that? Why is it such a catalyst?
It's basically like a dynamic traffic cop for the network. It lets the data center instantly reconfigure connections on the fly to handle huge surges in demand, which is essential when you're training these massive AI models. Its official launch is expected to be a big revenue driver very soon.
So the fundamentals look strong. The moat seems real. Let's circle back to the stock itself. The chart action here just screams institutional buying.
Oh, absolutely. The technical picture is incredibly bullish. The stock is way above its 50-day and 200-day moving averages. That's a classic sign of a strong, established uptrend. It looks like it's on track for its 8th straight winning month.
And the ownership numbers reflect that. Institutional ownership is what, nearly 94%?
It's huge. This is a high-conviction institutional play on AI. We've seen firms like Exchange-Traded Concepts starting new positions, Swedbank adding a big one. It shows that the big money believes in this story, even with some recent insider selling.
But doesn't that 94% ownership also create a risk? I mean, if the institutions control the stock and they all decide to sell at once?
That is a critical point. It's the double-edged sword of institutional ownership. It's great on the way up, but if sentiment shifts, that lack of a broad retail base, it could magnify the selling pressure on the way down. Liquidity could dry up fast.
Which brings us to the biggest risk of all. Valuation. The price tag here is just astronomical.
It's priced for absolute perfection. The trailing PE is over 250. You're not buying this stock based on today's earnings. You're buying it on what you hope they'll earn in like 2028 or 2029.
And it's trading way above the average analyst target.
Substantially. The stock is near 395, and the average analyst 12-month target is way down around $222.
That's a massive gap. So to justify the current price, they basically can't afford any mistakes.
Zero margin for error. They absolutely have to hit that 40% gross margin target. If revenue growth slows even a little, or margins stall at 38%, that gap between the price and the fundamentals could close very, very quickly.
And they're so dependent on the hyperscalers. If one of those big guys pauses their spending for a quarter.
Lumentum feels it immediately. The market would punish them for any slowdown in guidance. And you have to remember the volatility.
Right, the beta is high.
About 1.48, so the swings are almost 50% bigger than the overall market. You need a strong stomach to hold this one.
Okay, so let's make this practical. For someone watching this stock, what are the key things to look for in the next, say, 3 months?
3 things. First, the Q2 earnings release in February 2026. It has to be good. It has to validate the guidance. Second, the official commercial launch of that R64 switch. We need to see it move from hype to actual revenue.
And number 3?
Look for announcements of new hyperscaler deals or big customer wins. Anything that reinforces that leadership story.
And longer term, there's always that M&A chatter in the background.
Always. There's unconfirmed talk that a larger semiconductor or networking company might just want to buy them to get that proprietary AI optics tech. That would obviously be a huge premium. And there's also hope for long-term capacity agreements, which would lock in demand and smooth out the volatility.
So putting it all together for the listener, what's the takeaway here?
I mean, this is a high beta AI leader. It's attractive for tactical trading around catalysts, for sure. But the real story is for a multi-year hold to try and capture the whole AI infrastructure build-out. But, and it's a big but, you have to be willing to accept the huge valuation risk you're taking on at today's price. Lumentum's focus on proprietary photonics IP and its growing 60% exposure to AI and cloud demand clearly position it for structural growth. However, given the massive 370% plus run and the highly speculative valuation, the immediate question for any investor is whether the company can continue to out-execute and surprise the market with the required margin expansion, specifically hitting and exceeding that 40% gross margin target.
We'll keep tracking the catalysts here at Smart Wealth with Joshua. If you enjoyed this analysis, make sure you subscribe to stay updated on all our talks.